regarding Wall Street's kind of admission that it's possible to bet against leveraged products by shorting both sides of the product pairs. Defiance is coming out with an ETF that will short both TQQQ and SQQQ. For those that know me know, I believe these products are complete fraud designed to defraud investors, mostly the investors that do not know they have exposure to these accounts, whether it be in defined contribution plans, whether it be in endowments, whether it be in foundation assets. Essentially, managed money is compensated to give unknowing and unwitting clients exposure to these products. So for the past 5 years, I've been a whistleblower on this. Part of my claim, or evidence of my claim that this was a design fraud, is that the mathematics behind these ensure, and the flows of funds ensure, that the issuers of these products and their Wall Street counterparts are making huge amounts of money. Essentially, every dollar lost by an investor is a dollar gained by Wall Street in some capacity, whether it's the issuer, the swap counterparties, the distribution chain, the advisory teams, etc. So no money is made except for that which is in aggregate, except for that which is lost by investors. So I'm going to talk about this product. Sorry, let me back up. Because Wall Street is now creating products to bet against these structured financial products, as well as, other Wall Street figures are now saying that they're betting against these in their personal accounts. I've been doing that for 5+ years. I've published countless papers and reports on models that beat the market with lower risk. I just like to kind of criticize lightly this product, give some warnings from what I see, and then show you a better way to do it with no fees, no turnover fees, no paying commissions. TQQQ and SQQQ currently don't have a borrow, at least with Fidelity. Millions of shares available, over 1 million shares of SQQQ to be sold short with no fee. So we'll kind of criticize these. I'll give you a better way to trade against them if you so choose. Once again, I'm a whistleblower. I think these things are fraud. So the sooner they collapse is the sooner regulators and everybody else starts looking to some of my other accusations and really looks to protect investors. Fraud's never found out before it collapses, unfortunately. It's just the result of the society we live in. Too much money to be made by perpetuating or turning a blind eye to fraud until it inevitably collapses. So let's go ahead and look at, if you clicked on this preliminary prospectus, it would show up to here in EDGAR, the SEC website. So in looking at these products, just want to kind of talk a little bit about them. So they're going to be betting against both TQQQ and SQQQ, 100% on both sides. And here in the summary, once again, go ahead and read the whole thing. But they say to achieve their objective, they're going to do direct short selling, may borrow shares to short. Most of these products that are currently outstanding do not short shares. The short side, so the SQQQs of the world, the SOXSs of the world, the colds of the world do not actually hold any options. Everything is created, the exposure is created through swap agreements. Legal contracts, electronic IOUs that can say basically anything, which means they can be construed upon arrangements that are mathematical in nature and not on supply and demand. Also, with swap agreements, your counterparties are Wall Street firms, which means the profitability from one Wall Street firm having an arm's length transaction with another is that there's no chance for an intermediary like you or me to buy options and actually profit from it. The profits are locked in on the Wall Street side. So that's part of my claim as well. Good old boys club, creating products and services in which they benefit, no one else can, and clients, investors end up losing. Swap agreements it talks about, and then option strategies. It'll be interesting to see if they do sell short. Now that it's profitable and Wall Street's admitting it's profitable to bet against these, it is logical that Wall Street would create products that actually short these shares, which makes less shares available for people like you or me to bet against and raising the cost of the borrow. These products also have options tied to them, so they're going to have to figure out some way to either limit the amount of options that are also available or eliminate options altogether, because you can bet against these products with leverage, and the mathematics actually works a lot better when you're using options to bet against them than selling short. Something I haven't written a lot about, but something I do personally, and as we go on in time, I will definitely release those strategies as well, because now it's a race to the bottom until these products collapse. So some things to note here. So they're talking about shorting both products in their methodology, that their exposure is going to range between 80% short on one side up to 120% short on the other. And then they talk about rebalancing often so that they are not dependent upon any direction of what the market takes. The more often they rebalance, if they rebalance on a daily basis where it's 100% short, mathematically these products should actually not perform very well, because they do a fairly good job outside of extreme volatility of matching the daily performance of the underlying benchmark. There's a little bit of a bleed there. I've written about it extensively in my SEC whistleblower complaints. I wrote about it in my book. I actually have a trading strategy methodology that I put that beats the market handily with low volatility of trading these intraday. But from a mathematical standpoint, it will not perform very well. So a lot of shares are going to get sucked up if they do end up shorting shares versus doing swap agreements, which makes it harder to bet against these if you're you or me under the models that I have published. They're going to charge trading commissions on the high portfolio turnover. This is something I've also criticized about many of these small ETFs that you see every, Joe Blow and Furu and wannabe influencer on FinTwit in the financial community who has a $15 million net asset ETF that they promote and pump. Those things have turnovers of 2,000+%. This will definitely have turnover in the many hundreds of a percent. So back in the day, we called that churning to generate trading revenues and profits and commissions. I think the SEC doesn't care about that anymore. Obviously, there's going to be a lot of associated fees with this product outside of the fact that it's just not going to be, the methodology behind this is not quite as efficient as it could be. But once again, Wall Street products are there to not benefit investors. You're not going to find an ETF that outperforms ever over an extended period of time. And I'm one of the few that actually think about why is that. It's hard to underperform the market. My stance is a lot of these financial products are made so that Wall Street trading desk can take the other side, bet against them, use leverage, have outsized returns with no risk. But no one's ready to look at that at this time, except me. Definitely ways to profit again with that statement, if it is true, and I can certainly say many of my strategies are highly profitable. So let's talk about that for a moment. So going to my fraud website here, I've released in the book Structured Fraud, talk a lot about the man in the mirror model. It's one of the key models that I traded when I wanted to show the SEC through a real life portfolio of the mathematics behind these products and why they're flawed. Book goes into many, many details, some of which are disclosed to the public, some of which isn't from the issuer side, the mathematics behind these products. But if we go to the models and we just go to the man in the mirror dashboard, it's $10 if you're interested. So here we have all of Bank of Montreal products and Direxion products. So ProShares is not listed on here. We can add it. We'll add it later, but I wanted to showcase ProShares through another methodology, which I've talked about, the daily $8 richer, where you can follow along with the daily issuance. So if we're just going to select all these. So these are all products, all product pairs. They're in pairs. We're betting against them. The methodology I've put in a video out on it. The methodology is also in the book. If you don't know what that is, I don't want to recap it here. But effectively, you're betting against these products on an average basis for the mathematics in which they're construed. One of the keys in that is and this is right here in the book, the characteristics of the LATPs that we're exploiting, that I'm exploiting, and I'm not going to go into the math at this time. It's too complicated. We're keeping things very, very simple for you, but it's true and can be validated easily. The long leverage exchange traded products, whether they're 2x or 3x, so the TQQQs of the world, the SOXLs of the world, the Nuggets of the world, the FNGUs, I think it's FNGA now, they changed the ticker. The mathematics for those products decay slower than their inverse counterparts, the mathematics behind them. So I use the example a lot of these products are basically like betting on a coin flip on a daily basis. We don't know if the market's up or down, but if it goes up, and then a leverage factor or a probability factor and then a volatility factor. So is a coin going to be heads tomorrow? And if it's going to be heads, what return do you get on it being heads? So when we take that mindset and we know if a coin is not balanced at 50-50%, if it's a weighted coin, mathematically, you can bet against these products. So the man in the mirror model simply takes some of those mathematics that are embedded, and each product's different. The mathematics for each product's different based on the likelihood of the product, the underlying benchmark going up or down tomorrow, and then obviously the volatility factor. But when the mathematics are not even, regardless of anything else, that leaves an opportunity to bet against these products for profit, which is what I'm doing, and which is why they decline, and why you pull up a chart of SQQQ and you look at the total number of shares that have been issued over the past 15 years versus the number of total shares that have been issued for TQQQ, and it's many hundreds, multiple higher for the SQQQ because they're designed to decay at a faster rate. We can take that, we can bet against it for our benefit. So the man in the mirror dashboard is a way to visualize the performance. So if we go back from the start of these products in Q4 2008 with Direxion, and once again, we're highlighting all the products here. Bank of Montreal came out in Q1, I believe, of 2018. Direxion was obviously 10 years before that. But if we do that, we see an average quarterly return of 4.21%. The chart down here shows what the model I presented did. This is without taking into account borrow fees, but we're just looking at the performance. We're putting our eyes, our thinking cap in the eyes of the issuer of these products. But we're looking at how it outperforms. Mathematically impossible returns that are ascribable only. My claim is only if these products are a design mathematical fraud. My claim is the issuers know the mathematics behind these before they created them. Logically, it makes sense. Financial products are not created unless they're wildly profitable for those that are creating them. And then intuitively, if you sell something that has a leverage factor to it, that extra money, because these products aren't investing in the vast majority of the assets in these products aren't investing in underlying securities, and they're not investing in options. They're swap agreements, which means that if Goldman Sachs, JP Morgan, Nomura, Citigroup, write a swap agreement on 3x performance on $10 billion, every percent that goes up, they owe the 3x leverage on that, which can be quite expensive. And it doesn't matter if you think that they're just, holding that risk on their books or whether they're hedging with some other portfolio somewhere else. If the product goes up, they lose money. So on average, in aggregate, logically, the side of Wall Street loses a lot of money and has a lot of risk if these products perform for the benefit of investors. They have to not perform for the benefit of investors for Wall Street not to lose their shirt. And it stands as logic that the worse they perform, the better off it is for Wall Street. They get paid on the swap agreements, whatever that arrangement is, split between someone in the distribution chain, the swap counterparty, the issuer of the products, the distribution chain, the advisors, the managers that are getting paid and splitting the fees or profitability of the product. So if we just look at the performance, once again, this model's $10 if you want to buy it. If you don't, here's an overall look. You can see when the S&P 500 went down 22.56%, man in the mirror model for the first quarter that these products were issued went up 16.59. We look at 2020, another extreme in the market. we look at the first quarter of 2020, Man in the Mirror model went up 20%, S&P 500 went down 20%. So these products are mathematically, some would call it flawed. I would say they were designed this way on purpose. You just have to bet on the side of the issuers. So Defiance should copy what I've published to the world, and it would have a better return. These products need to decay over time, and when they decay, the issuers issue more of these products. Once again, the full details are in the book. I've done videos on this, SEC reports, all of that has been made public. Go for it as you will. So let's do some interesting things here. Let's look at some of these products. Because some of these products decay faster than others, we can pull up some of them. So if we just look at gold, we have a 7.6% quarterly return, 26.45% annualized return over time. We can look at one of these products, 10.46 when we just look at the junior gold miners, which are higher volatility, versus the 5.31% per quarter for the non-juniors, the major gold miners. So we can see how that compares with the gold miners for Bank of Montreal. Once again, these began trading Q4 of 2020, and lo and behold, we get a close number here. As we look at all of these products together, we begin to see a better picture that the issuers of these products may not know the math for any one product. They may not know the math of what happens tomorrow, but just like Vegas, they know what the aggregate math is. And all I did was reverse engineer that. Some models perform way better than others, but all of my models beat the market when looking at the entire issuance of these products without leverage over time, substantially, by over 2x. So eventually people are going to ask the question, how can this be? And then hopefully everyone realizes that betting against these products in the ways I've outlined, and hopefully other quants, other firms realize this is a race to the bottom. They start publishing some of how they bet against these products, because it's going to be a pretty fast collapse of these products. Logically speaking, if enough people think the way I do, then do the math behind it, and going forward. So I'm going to show you a walkthrough of TQQQ, SQQQ. In one of the models, it's under the Handsome Rob now, but what we did was we created a walkthrough live trading dashboard for betting against specifically TQQQ and SQQQ, which is ironic because did this before Defiance had announced their intention to do the ETF, which goes live on June 30th. But essentially in the book, I outline the Man in the Mirror model here. And I give the example that anyone can follow along. You short $800 of TQQQ, you short $1,000 of SQQQ. You do that on the first of the quarter. Anytime it drops below, I'll just simplify it. Anytime it drops below the original $800 on the SOX L side or the TQQQ side, the leveraged long side, you short additional shares until you reach back to that X value. On the other side, same thing. If it drops below, the short drops below the initial $1,000, you short additional shares until you reach back to the 1,000. If it goes above it, you just leave it alone, and at the end of the quarter, you reset the position. That's the simplified version of that. So let's go ahead and look at the model. This is real trading. This is obviously just a dashboard we created, so I don't have to show my Fidelity account, but in a small enough portfolio that everyone can follow along. So on 4/7, I shorted as close to $1,000 of SQQQ as I could. I shorted as close to $800 of TQQQ I could. And then when it dropped below the $800 original, which happened twice on 4/8, very, very bad day for TQQQ, I shorted additional shares. Don't have to think about it, simple model. I placed market orders, I shorted. On the TQQ side, and we're now short 22 shares. Our net cost was $888. we have a loss of 47.11%, an unrealized loss of $418.67. You're thinking to yourself, this is a stupid model, horribly done. Except we are also short the other side, as Defiant should do. So man in the mirror model, we shorted 20 shares up front on 4.8, very volatile up and down day. We shorted another 3, 4.9 shorted another one, 4.9 shorted another one, 4.9 shorted another 4. This was that huge day when SQQQ dropped 50%, near 50% in a day. Oh, excuse me, near 30% in a day. SOXS dropped 50% in a day. And then some more trades, another 2 on 424, another 2 on 425, another 2 on 5.1, another 2 on 5.2. Once again, just doing the simple model, not thinking about it, not taking any stance, not looking to maximize, not using leverage. But TQQQ doesn't have a borrow, SQQ doesn't have a borrow, so we have a great opportunity to do this. So now our total short position went from $1,800-ish to start to $2,300. We made $147, which is 6.23%. You think to yourself, wow, that didn't beat the market. However, the beta on this thing is very, very low. Fraction. When you average that out, the quarterly beta is about 0.2 of the S&P 500 in aggregate. When we look at, once again, we look at all of the products like I outlined here in Man in the Mirror. So very good model to follow. Eventually going to build a $10,000 portfolio that people can follow along and just see how easy it is. Once again, I'm just going to bet with the shares. Others who have talked about these products who are now betting against them. Once again, race to the bottom now. Now 5 years of my work is going to come to the forefront very quickly. Ways to bet against this. You can short these products the way I've outlined in the book for mathematically guaranteed return. And that is mathematically guaranteed. These products, once again, perform on a daily basis. They're not dependent on cash flows. They're not dependent on supply and demand. They trade off of what's called an indicative value for the ETNs, a mathematical value for the ETFs. So you can play against that. It's a game of blackjack. I'm counting cards. I'm teaching you how to count cards. You can, scream and say this can't be possible, or you can validate it. Anyone else can validate it. It's not wrong. I'm going to show you proof. I'll show you a place to look. If you don't want to buy the book I published for $10, here is the prospectus for SQQQ. And I want you to find in that this is a table of estimated returns, once again, based on the volatility factor and the probability factor for these products. So if the underlying index goes down 60% and the volatility is only 10%, here's what the expected returns are. This chart, this is very cool, right? So the issuers don't disclose that they weighted these things as two different coins. They don't disclose that to anybody. They do. The only inference you get of that is on this table for SQQQ. If you look at the TQQQ table, you will notice that it is not the inverse of this. And if it's not the inverse of this, it's not that hard mathematically. It's hard for a lot of people, but for people who are math experts, finance experts, even accounting experts, will be able to easily kind of see the factors that are used there and why I chose, in a very general sense, the 1.25x versus 1x shorting of both products. Once again, they're not mathematically inverses of each other, even though these products are sold as inverse daily products. They should perform. So once again, that's a hint. Use it. Bet against these products to your liking, or don't, or follow along. So if you want to follow along, this will be live at some point. My purpose isn't to make money off of my research. My purpose is to destroy this fraud, become famous, become the highest paid whistleblower in the history of the world, and really, most importantly, prevent investors from being taken to the cleaners. And I'm not talking about you that are investing it in your brokerage account and walking into casino normally. I'm talking about the managed money, which is by far the majority of the purchasers of these products. giving those who have no idea they have exposure, having them suffer the losses so that the managers somewhere on Wall Street can go buy another Lambo or another yacht. It's disgusting to me. It's evil in my mind, and it goes against my sense of fair play. Intelligent, smart people, powerful people need to be restrained, and we don't have that in our society right now. We don't have a lot of incentive to protect investors. We just let things kind of go bad until they blow up, and then we all turn a blind eye to those that caused it. So let's do a race down. Validate what I say. Take it to outside mathematicians, anyone you want. It's right, but go ahead and validate on your own. Follow along if you want, and then separately, I put this in another video, but it's pretty cool. So Man in the Mirror, $10 to play with. I have another one called the Double Down. I'm not going to tell you that model, it's in the book, but if you want, it performs even better. So if we select all of these products again, now we have 5.06% return and 21% average. Oh, sorry, that's only 2018. 5.49% and 23% annualized return. And once again, slightly more volatile than the Man in the Mirror, but not a lot, and returns are a lot greater. So once you understand that these products are simply math, that they can be bet against, then the light bulb goes on. I've used the analogy of Takeru Yobakashi, the Japanese hot dog eater, who doubled the world record of hot dogs in between the year 1999 and 2000, or 2000 and 2001, because he read the rule book and figured out you can dunk the buns and the hot dog separately. You don't have to eat the hot dog and then swallow, drink water normally. He doubled the amount of return. And now Joey Chestnut increased that number from 25 to 50 hot dogs that Kobayashi did to now it's 76 is the record. So when paradigms shift and people look at things differently, fraud becomes obvious, making money becomes obvious. Like I said, I've been waiting 5 years for someone else to pick up on this work. And now Wall Street is admitting it. And because it's published, Bloomberg wrote a story on it. Now you have these products coming in. It's a race to the bottom. You will see more institutions start coming out and betting against these things. And you'll see a lot of similar strategies as I've already published publicly. Here's a cool thing though. These products, because they're math and they're based on math, and we look at the incentive from the issuers of these products, there are indicators on when to go long these products, which means that even if there were no short shares to short and there were no more longer options to bet against these products, which I think is going to be an eventuality on the way to this collapse. They'll work with regulators and somehow put a ban on betting against these products. But when you understand the math behind them, you can also tell when to go long these products. So I'm not going anywhere. I'll keep releasing more and more until these products collapse, and then the world can figure out they're a fraud. So sometime next week, I will give the public proof positive of hundreds of millions in one defined contribution plan that goes against ERISA rules and guidelines, goes against fiduciary responsibility, goes against the warnings in the prospectus. And it's the one thing outside of ERISA plans the SEC has actually taken any action on from my whistleblower complaints, is that fiduciaries were holding these and giving exposure to investors over an extended period of time. The SEC never asked questions, were those advisors getting paid? They were getting paid, and someone should have done a story on that. The SEC should have looked into that further. They didn't. Someone who does will find out that we have a corrupt system. And why are these in advisory accounts? It's because people are getting paid to put them in advisory or managed money accounts. Otherwise, they wouldn't. No smart, and people who manage money are smart. I don't believe in stupidity. They're not accidentally doing this. They're doing it because it helps their wallets get fatter. So talked a lot. So double down. If you want this one's $15. Go back to Man in the Mirror. So some cool things, right? This is a probability factor times a leverage factor or a volatility factor. We can design, using the Man in the Mirror. We can look at some of the more volatile products and see how they show up over time. Where's yin yang, and go from there. So even with Man in the Mirror, we get a 5.69% return and only have one down quarter when the market's down 16%. This is down 8.8. So once again, cool thing to play with in designing a portfolio. Other ETF issuers should look at my work and make products that actually are profitable. That won't happen because that's not the game. Wall Street doesn't want Wall Street turning on itself. Competition is not a thing Wall Street believes in. But I'm gonna force it. I'll force the issue. So I think that's all I want to talk about. Go ahead and pull up the TQQQ and SQQQ. Look at this table really closely. And if you're really great at mathematics, you could probably figure out the factor between the two pairs, and you can do that for every pair, and you'll be a little bit surprised. So, or you can read the book, $10. I got a couple chats here. Let's see. Okay. All right. So that's it. All right. Thanks, guys. Bye.